Welcome back. You're watching the Global Common channel here on the Singapore FinTech Festival 2020. It is the Investor Summit. Now we're going to focus on investing in a COVID world, a co-COVID world. Of course, the pandemic has caused significant changes in the world of venture capital in particular. And globally, markets have reacted differently, with investors wondering where to be the most optimistic about an early recovery. So Shwetank Verma, who is co-founder of and partner of Leo Capital, will moderate now a panel of fellow investors to discuss investing in a world going through a pandemic. And he'll be joined by Nicolas Baze, partner at Partech, Joe Away, who is a venture partner at White Star Capital, and Matthieu Baret, who is the managing partner at Idinvest Partners. So to pose questions to the panel, once again, you can click on the yellow button that is beneath the session window. But we go live now to Shwetank and his panel of investors to find out how the COVID-19 pandemic is causing investors to change.
Thank you, and welcome to this panel on investing in a co-COVID world, where we will be taking a global perspective on the impact of the pandemic on venture capital investments. I have the pleasure of moderating a highly distinguished panel and truly global panel, where I'm joining you from Delhi, Nicolas is from San Francisco, Joe is in Hong Kong, and Matthieu is in Paris. Before we start, let me ask my panelists to briefly introduce themselves. Nicolas, over to you.
Hello, everybody. I don't know if I should say good evening, good morning, or whatever. It's great to join this panel. I am a general partner with Partech Partners. Partech is a global fund. We have about 2 billion under management. We invested across stages from seed to growth. So that means we write checks very early, as little as 250,000, all the way to $50 million into well-established companies. We invest that money across mainly 4 continents, but very actively in those 4 continents that are Europe, US, Africa, and Southeast Asia.
Thank you, Nicolas. Joe?
Yeah, I am a venture partner at White Star Capital. We are also a global investment platform with a global footprint. So we are in Canada, Montreal, Toronto, in the US out of New York, London, Paris out of Europe, and more recently myself in Hong Kong and Tokyo as well. We focus on Series A, Series B rounds with an average check size of $4 to $8 million. And we also are really looking at a globalization play and synergies across the world.
Thanks, Joe. Matthieu?
Yeah, hello, everyone. I'm Matthieu Baret. I'm a managing partner at Idinvest Partners. So Idinvest is the global, is a pan-European venture platform with over 2.3 billion euros under management. We have offices in Paris, Berlin, and London, and also in Shanghai. We invest in all sectors in the digital space, both at early stages, where we have funds dedicated to Series A and Series B. And we have also a growth fund that can write checks from $50 to $100 million.
Great, thanks. A lot of firepower between the three of you. I'm the co-founder of Leo Capital. We are an early stage investor based out of Singapore, currently doing more investments in Southeast Asia and India, but we just opened our Philadelphia offices and started investing in the US as well. Let me kick off the panel and start perhaps with you, Matthieu. Would you be giving us a quick overview of the impact of the pandemic on the ecosystem in France and how you've seen the story play out?
Well, I mean, sure. I mean, if you look at the numbers, you see that Q2, there's been a sharp drop, in investments in Europe. And that has been, cooked up very quickly in Q3. Actually, I guess September was probably the highest month ever in terms of investment in Europe. And last previsions show that we will end up the year with about 40 billion euros invested in venture and growth overall, in Europe, which is slightly above, 2019 numbers. So we've seen a very, very strong recovery after the Q2. And we see it, on a day-to-day basis, where we're seeing a strong deal flow, very competitive deals, and moreover, a lot of international investors still very attracted, by Europe. Sequoia has just, set up their headquarters in London. And if you look at numbers, more than 50% of the funds, invested in European venture comes from outside Europe. So it's still a very attractive market, still, after the COVID period. And we're seeing also a growing interplay of European tech, between venture capital, private equity, public markets, creating really more M&A opportunities, strong pipeline for future IPOs, and a systematic, recycling of experienced entrepreneurs and talent, to build new generation companies. So still a very, very active ecosystem. And it's as if the COVID has not existed. It has had, and we'll come back to that, a strong impact on some sectors. We're seeing more usage of mobile or telehealth or marketplaces. But overall, it's rather positive.
Interesting. So slowdown in Q2, recovery, and more in Q3.
Exactly.
Nicolas, what's been the experience in the Bay Area?
Silicon Valley has a culture of very fast reaction on one hand, and high velocity of decision making, and then also a culture of long-term perspective. So what you've seen as a result of that, I think if you look at the macro number, is actually pretty stable and active pace of investment, with some differences between later stage and early stage, but still overall, very, very, very solid continued pace of investment, because Silicon Valley on top of that has the added advantage of having perspective fed by the experience of prior crises, right? It's by far not the first crisis that the tech industry has faced, and to a large extent, I would say it's a much milder crisis than the 2000 or the 2008 crisis. So as a result of that, I think what you've seen in the Silicon Valley ecosystem is, first of all, very quick recognition of the crisis, very fast action on the crisis, and then very quickly a recognition that this is in fact a long-term accelerator of the digital trends that the tech companies are benefiting from, and so active re-engagement of investors and entrepreneurs as a result. So it's, I could take the point of view that it's actually been that a lot of investors and entrepreneurs see this as a great thing for tech, a terrible things for human beings, but a great thing for fundamental tech trends.
Right. Yeah, adoption certainly has picked up. Joe, what have you been seeing on the ground in Hong Kong?
Yeah, so I think a very similar story. When Corona first hit, obviously there was a very large impact in Asia because it was the epicenter. So China in Q1 in particular saw a huge drop in deal flow. And I think what's interesting then after that is how Asia has sort of split, bifurcated, where China, having actually really contained Corona by Q2, I think it actually was starting to really change in sentiment and almost have a very positive outlook that it was going to come out relative to the rest of the world better positioned, having sort of got it behind it. And a lot of the same acceleration of trends is sort of happening. So similar to the story in Paris, I think that they expect deal flow to be up at least 10% year on year, despite that huge drop in Q1. And so, I think in Q3, Q4 overall, the deal flow has actually been up more like 30-40%, which just goes to show that it's been a very, very sustained and I think looking at the capital markets, looking at the various rush of people to IPO, you can really see that sentiment carrying sort of up and down all stages and into all markets. In the rest of Asia, it really then has depended on how they've reacted. I think places like Indonesia and the Philippines, which have done a less good job of containing the virus, have seen much worse deal flow. It's been much harder for the startups as they've been impacted a lot more. So I think overall for Southeast Asia, where probably once you strip out the big rounds done by Grab and Gojek at the end of last year and beginning of this year, you'll probably end up being slightly down, like 5-10% on a relative scale. So still not as badly hit as I think people had perhaps expected, but maybe not as strong as the rest of the world.
Yeah, no, good point. I think for us in India as well, we haven't really managed it that well, but there's been a full recovery in deal flow. But, turning the perspective away from sort of deal flow to the consumer perspective, what behaviors do you think will change? For instance, we had a very hot travel company. It was about to do a massive raise in Q1, and then of course the wheels fell off. And the question now is travel coming back? So let me frame the question slightly more broadly. What is the new normal? What customer behaviors have changed for good? And what will revert to the pre-COVID world? Nicolas, do you want to start us off on this discussion? What's your view?
So look, I don't have a crystal ball, but I think, as I said earlier, I think this crisis has acted as an accelerator of trends. So the changes we're seeing, I mean, I'm going to tell you the obvious things, which is, anything remote has been accelerated and will continue to stay accelerated, right? So remote working, remote learning, remote training, remote shopping. I mean, any of those trends, I think that were actually already here are just going to continue. Now, the one trend I would say that probably will stay in a more meaningful way relatively than compared to before is probably the remote working trend, right? It's very clear, and the leading tech companies in the Valley are showing the way already. People are not planning to return to work the way they were before. Remote working will be almost the norm in the next generation large tech companies. You've seen large tech companies like Pinterest canceling their lease in San Francisco. You've seen large companies like Salesforce, Google, Facebook telling their workers that they'll be able to work remotely, maybe indefinitely for some, certainly to a much larger extent. And as companies have, through this crisis, have been able to get much more comfortable with the efficiency of the remote working system and realizing cost benefits from that clearly, and being able to also bring on board a much more distributed workforce more easily. Those trends are now here to stay. I do personally believe that humans are highly resilient and like human face-to-face interactions. So I see personally other trends like travel and going out and things like this coming back just the way they were before.
Yep, I think travel is going to come back. Interesting perspective on remote work being here to stay, and perhaps how it might lead to some burnout. We can touch on it a bit more, but Matthieu, do you want to sort of jump in and add a little bit of your perspective on consumer behavior?
Yeah, sure. I fully agree with everything that Nicolas said. If I want to add something, is a new behavior which is here to stay is telemedicine, right? We are an investor in Doctolib in France, which is the leading telemedicine platform. We were, because we sold it this summer, an investor in Teleclinic in Germany, which was the leading telemedicine platform in Germany. And while, those two platforms were doing well, growing, etc., we've seen suddenly in April, during the first lockdown, a surge, in teleconsultations. But I mean, it was absolutely massive. And that, increase in teleconsultation has stayed, even after the lockdown. And I think people are getting more used, to use teleconsultation platforms. And that has also had an impact on governments, because they have also adapted, sometimes the regulation, to allow those telemedicine platforms, to operate. And for instance, in Germany, while, before the first lockdown, the teleconsultations were not, refunded, by the state, that has changed, during the spring. And also that has contributed to the surge in teleconsultations, to a point where we have, attracted interest from many players, and we got several offers on teleclinic, and we solved it during the summer. But this is a new maybe behavior that was not that big, before the COVID, and that has changed, massively after the COVID. And just to also react on what you said on travel, we are also an investor in a company called Secret Escapes in London, which does, discounted travels. So obviously, we've seen a huge drop, of course, in activity in travels during the first lockdown. And the good news is that, back in Q3, in June to August, we've seen, back, a strong, increase. So back in travels, we've not come back to pre-COVID levels for sure. In Eastern Europe, that was pretty good. In the rest of Europe, we were like at 40-50% of pre-COVID levels, during the summer. Now a little down again, with the second lockdown. But that has given us confidence that once this is all behind us, people will travel back, at least for leisure. Maybe not as much as before for work, but for leisure, that will, come back to pre-COVID levels pretty quickly.
Thanks. Yeah, no, telemedicine is an interesting one, and I clearly see the pickup in both Europe and the US. Joe, in China, of course, telemedicine was already a big thing with Ping An Good Doctor, etc. So what is the new behavior in China that we should all be watching out for?
Well, I think in terms of a lot of the sort of telehealth platforms, they've obviously been a mix of sort of online and offline. And the structure of that market was such that that this has definitely accelerated the sort of adoption more to the online side, which I think is a global. We see it with also our portfolio companies, Parsley Health and Dialogue in the US and Canada. And it's a sector that we're following sort of broadly through the whole of Asia. So we definitely agree with that being a strong trend that's here to stay. Funnily enough, I think on the remote working, well, it's something that as a thesis globally, we're very strong on. We have a portfolio company, Spatial, that's very focused on VR teleconferencing, which has been an interesting thing to try. But because they have been impacted so much by COVID, people actually are maybe less focused on working remotely, and that cultural shift I don't think is going to happen, partly because of that and because of more conservatism. So whilst we do think there is a bit more of a trend to doing Zoom calls, etc., we do think sort of face-to-face meetings will be actually more of an ongoing thing, and working in offices is probably going to be a more prevalent trend still here. I think the other trend that we're particularly seeing a lot of uptick is, on the food delivery side. Obviously, you saw the big reaction to the DoorDash IPO in the last sort of day or so. But our portfolio company, Freshly, saw enormous growth, and it was partly because of that. It was originally looking to IPO next year and actually ended up getting preempted by Nestle, which we ended up selling to for 1.5 billion. So that was again, I think something that's here to stay. People have changed their behavior after I think a year and a half of ordering in, it's going to be something that is just going to be acclimatized as a day-to-day thing.
Interesting. So yeah, I think from an Asian perspective, the remote work trend is not that strong. I think it goes to the point that the offices never really shut down here. So it's a very interesting distinction between what's happening in the Bay Area, where Facebook has said, work from home for the next year. And I'm sure some of the others have also said this. While in Singapore, right, offices are open, work from home is encouraged, but I think pretty much everyone is going to the office regularly on a weekly basis. In India, the offices are completely open, so everybody is working from the office already. So that's interesting. From us, one of the biggest things you've seen is a massive uptick in gaming, and especially casual gaming across sort of the more older population in India. And that has been interesting to watch how, the sort of some of the social games have come online, and that ecosystem is developing very fast. Bunch of people building very interesting apps on Zoom, effectively linking families together and playing sort of group games while in lockdown. Probably not sustainable. So I think Nicolas, you want to say jump in, please go ahead.
Yeah, I wanted to just add a more general point. I don't think this is just about COVID, right? I think if you look at the companies that have the businesses that have suffered in this crisis, there's really three types. There's the ones whose business was materially affected by the inability of people to be mobile, so travel being one. That's actually a very small minority of businesses. Then you have, by and large, the other two types that suffered were businesses that were digitally behind, right? And then the third category being businesses that were in the process of fundraising in the tech area. But I think there's also, with COVID, the recognition that, first of all, this may be the first COVID type crisis, and there will be others, and that businesses need to be agile and resilient, regardless of what crisis hits them. And I think those are the trends that are going to stay. That's why tech is strong right now, is because there's this realization, profound, practical, day-to-day realization that if you're not digitized enough, if you're not agile enough, if you can't function remotely, you are constantly at risk. And that is, to me, the profound, lasting impact of COVID on how businesses get structured, organized, and how these trends, will go way beyond COVID.
That's a great point. I think, if I remember correctly, Winston Churchill had said, "You should never let a good crisis go to waste," and that's probably what. Actually, I think it's a good point to sort of bring up, Nicolas, that bunch of crises have happened in the past, right? The financial crisis, SARS. Given you guys have all been investing through those crises, any trend, anything you pick up from those crises that you think apply to now and something that entrepreneurs and companies should think about? Matthieu, do you want to jump in on that one?
Yeah, I mean, from what I remember I was a VC back in 2001 and 2008, and the biggest probably impact that we had, on our returns was that there was no M&A, right? No IPOs and no M&As for 2-3 years after those crises. So we had to keep, the assets, longer into the portfolios, which had obviously a strong impact on our return on investment. So my strong concern back in March was what will happen, right? And if you look at our ecosystem, the ecosystem today is completely different from what we had, back in 2008 and 2001, because we have a very, very strong tech ecosystem, which was not there, if we remember, back in 2008. 2008 and Facebook was barely what it is today. Apple just released the first, iPhone, so there was no app at all. And Google was not where it is today. There have been IPO in 2004, and Amazon, of course, was very far from what it is. So and not the Salesforce, so there was absolutely no tech ecosystem. What today we have a very, very strong tech ecosystem with a lot of cash, very active, and that has changed everything. So and very quickly, after the end of the lockdown back in June, we've seen Facebook doing the first, acquisition with Jiffy, and that launched, the M&A process. We've seen the stock market for tech, stocks doing very well, and very quickly have been very reassured that this crisis is not at all as the ones we've been through before, at least for the tech, ecosystem globally, because we have that very strong, environment, of tech companies, globally.
Yep, that's a great point. Let's shift gears a little bit and get to the nuts and bolts of investing. So, how have you sort of changed your investing process? How has diligence worked? How has sourcing worked in this current world where we've all been stuck in our respective homes and maybe some office visits? So, Joe, what has changed for you guys? How have you managed to do investments in this year?
Yeah, so I think in many ways things haven't changed for us. We had a very global footprint, which always meant that at any one time, a lot of the team that was working on any specific transaction would not necessarily be in that continent even. So we have always worked on a diversified basis. I think, having said that, we have never done a deal prior to COVID without any interaction, having never actually met the founders. It's ultimately a very relationship-driven thing. You want to build a rapport and a level of trust, between both sides, and that's much more difficult to do if you are doing that purely remotely. So we've been actually quite lucky in the sense that out of the sort of two most recent deals that we did, the last one is FinAuto out of Munich. Our partners were able to actually travel, before things got locked down and actually meet the team and do a lot of the in-person diligence, but definitely all of the latter stages of the process were all done remotely. We did close another transaction where we actually didn't meet the founders during the entire process, but we had actually encountered them previously. So that also was one where, whilst we hadn't met them in the last year, at least having that relationship really helped us get over the line. Fast forward to today, we're actually in the process with a couple of companies, and none of which we've actually met on, in person. And I think we are looking to term sheet and close with them, going through that entire process. I guess only time will tell whether that really changes the fundraising dynamic, the governance dynamic between us. But I think that's something that's here to stay. I think it's something which in every single market we're in is a sort of overall trend. The exception to that, again, is probably China, where because things are back to normal, you're able to actually do a lot of the face-to-face and people aren't impacted in the same way. But it will be interesting to hear other people's perspectives.
Yeah, absolutely. Nicolas, how have you been dealing with this?
Yeah, very similar feedback. If you look at the numbers, the aggregate number of investment, VC deployment, you'll see that actually the one area that suffered or that shrunk is the very early stage, right? And the reason for that is exactly that the main and only change and main inhibitor to investing right now, which is particularly acute at early stage, is the restricted ability to meet with the founders, right? Which is because at late stage, at least you have some data to look at and historical data about the business. When it comes to a seed and a very early stage, it's about the people. So for us, it's been the same thing. And when I say for us, I think for the industry at large, it's very much what I've observed. We have been active, we have made investments, but a large majority of those are either in entrepreneurs that we already knew or in teams that we were able to meet. Now, we have made exceptions, and more so than we ever had before. We don't like to do it. We really don't like to do it at early stage, right? So we also don't think it's here to stay. Soon we'll be able to meet people normally. The inability to travel is an issue for people who invest more than locally, for sure. But that's really the only inhibitor. But it's a big one, and it has affected the pace of capital deployment. It has affected, from the entrepreneur perspective, it has slowed down the process of fundraising because it takes more time for both sides to build a relationship. And particularly if you need to build a syndicate of more than one investor, you need to build, which is typically the case in very early stage rounds where you have a syndicate of 4, 5, 6 investors. Building that momentum is hard enough with one, so doing it with 5 is really, really hard, right?
Yeah, if I can add, I mean, where on our side we've been severely hit, by the lockdown is on sourcing, right? You don't do sourcing behind your screen, and trying to cover, Europe from one location is very difficult, right? To do it from Paris. And usually, you travel, you go to conferences, you meet people, you do boards, in the different hubs in Europe, and that's how you get access to the deal. You know what's going on around here, and that's something we've not been able to do at all, for the past 6 months. So we still have, of course, sourcing through our connections, but it's not as efficient as before.
Yeah, no, I hear that, and I echo all of you what you've said, and in the sense for us. As early stage investors, the ability to go and sit in the office was a key part of DD, right? For me, I would just go and sit there for 3 days, and you get a good pulse of the organization, you get a pulse of the CEO, and it makes it easier to build conviction. I agree that we've been trying to replicate that with Zooms and sitting in and on some of the team meetings, etc. But it just takes longer, and it's not as natural, not as effective.
But here's the paradox, right? On one hand, we've learned to be much more effective remotely. On the other hand, I think we've also learned more and becoming more aware of it too, that of the value of relationships, because a lot of the world right now functions on existing relationships that have been built, right? That's true within your family, it's true with your friends, it's true within your teams, your existing teams. Existing teams function very, very well because people have known each other, right? That has limits at some point, right? When you build new relationships, new partners, new customers, and we're going to start hitting the limit of that fairly soon, right? So, which is why we need to get out of this crisis. But so COVID to me has also highlighted that, right? We are able to actually function very, very well when we have very strong, solid, trustworthy relationships. But building those requires the face-to-face.
Yeah, it's interesting to me that the deals have gone up, but to your point, all of us have done deals with the entrepreneurs we knew. So clearly, brand new entrepreneurs have suffered in this time period. I guess apart from a vaccine, there's very little they can do. But any thoughts on what, if you were a brand new entrepreneur, any thoughts on what you should be doing at the moment to set yourself up for being funded in 2021?
Depends on your stage, first of all. So I think we need to, maybe give you a different answer depending on stage, because I think on the later stage or growth stage side, it's actually not that hard because established businesses or emerging leaders actually have an advantage right now, right? They can accelerate their business. They have more demand for their business, most of them, if they're in the right sector. So. And they're more able to, build initial relationships remotely. When it comes to really early stage, I think one generic advice we're giving entrepreneurs is plan for more time. I mean, whether you like it or not, that may not be a super practical advice, but it's a necessity. put yourself in a position to raise money over a longer period of time, and leverage your existing relationships as much as possible, and work on local relationships as much as possible with people you can physically meet, because it's just very, very hard to convince investors purely remotely, right? So build very strong local advocates and then leverage those.
Yeah, it's sort of harsh but fair, I guess. That's what it is, and pray for the vaccine to come quickly so that meetings open up. Let me sort of shift gears a little bit and talk a little bit more about how has portfolio support been during this pandemic. Sort of what is the successes that you think? What have you done specifically to support your portfolios? Matthieu, if I may request you to sort of jump in.
Sure. So now we've done portfolio reviews on the two angles. We've looked at if the business and how the business is impacted, has been impacted by the crisis, and especially the lockdown. And second, what was the cash situation of the company? So we put two levels of risk with green, orange, and red lights on our portfolio, and then we look at that. So we've done the first analysis, and then for the companies that were at risk, we've done some reforecast, and we've looked at what we could do, to support them. And so that has led to some refinancing within the portfolio. The good news also from that pandemic, during that pandemic, is that there was a lot of cash, around the tables. All the funds were plenty of cash. A lot of cash has been raised, by funds in 2019, at least I'm speaking for Europe. It's been, a huge year, and most of the VCs around the table were ready to reinvest. So that was the good news. So we've done that. For some of them, it's been a bit more complicated when there were debts, around the table, for instance. And also, we had in Europe, which is the state, guaranteed loans. That was also very helpful for some of the companies also. So that's almost free cash. And so we've worked, on refinancing all these companies. Enough, we didn't know at that time how long that would last. So we've given them at least 18 to 24 months of cash. And that had an impact, actually, back in September and during the summer, because they were not that, in a rush, to raise money, all these companies, right? But that was good for the portfolio. And then when the second lockdown occurred back in October, it was not at all the same situation. They were all very well financed and ready, to deal with the situation.
Okay, Joe?
Yeah, so a very similar situation. We went through the portfolio and very, very quickly tried to get 18 to 24 months runway for every single one of them, whether it's through cost cutting, through drawing down on debt facilities, or doing top-up rounds. I think we actually ended up being quite lucky in the sense that a lot of our portfolio ended up being quite defensively positioned in food delivery, health tech, even companies which we thought initially were going to be very badly affected. So, for example, Tier Mobility in Germany, they ended up being shut down for over a month, but actually when things reopened, the people didn't want to use public transport and ended up using scooters more. So it ended up being surprisingly positive on a net basis for our portfolio. I think the sort of going through line item by line item on the cost side, renegotiating rents, trying to look at the suppliers, really like being very, very sort of micro-focused, and having that discipline was very, very helpful for companies that was almost previously growth orientated, and being able to deal with a different type of war, I think was a very educational experience for some of the earlier founders in particular. But on a net basis, I think it was pretty much the same for us as well.
Yeah, some really tough conversations around cost cutting and squeezing suppliers. Nicolas, do you want to give us some more color on how you think founders should be managing these tough conversations?
Yes, so clearly we had similar conversations. actually thought personally that it was one of those fascinating, unique opportunities to actually play a value-added role as an investor, right? Because putting a new companies in a position to have at least 18 months runway and work through the crisis and optimize through the crisis is not easy for many companies, particularly at the early stage, because they typically aren't set up to do that. And so I think it's been a fascinating experience as an investor to be able to do that and work closely with entrepreneurs on that. And you know, the messages that we were pushing were you know, basically trying to share both our experience of prior crises and also trying to foster sharing of experience between the different portfolio companies, and encouraging entrepreneurs to think from a blank page almost, right? In many cases, forget about your initial growth plan. They're just not, you know, the world isn't what you thought it was going to be. So think about your company in a very open-minded way, and maybe a completely new way. For some companies, it's obvious to just continue to do what they were doing in an optimized way. But for other companies, it was really about reinventing themselves, right? You know, I give you an example. We had it's kind of an extreme example. We had a company in the US that is a leader in the on-demand massage business called Zeal. You know, obviously the massage therapists were not able to meet with their clients, and so that was an immediate hit onto the business. They were able to come up with very clever ways and very large contracts with and signed up very large U.S. companies. I'm not sure I can reveal the names, but for remote training and exercise classes that companies would provide to their employees, and generate a significant new B2B business out of that, right? So that's one way of reinventing themselves. And so I think a lot of what we've done is really try to encourage entrepreneurs to think out of the box in an unconstrained way and be partners in that, you know, trying to say, look, we recognize that this is a crisis. Let's turn this crisis into an opportunity.
Yeah, no, I think the ingenuity. Sorry, go ahead, Matthieu.
Yeah, what is interesting is we've seen in a lot of companies where we have reduced costs, right? Marketing costs, and some people also have put some people on a partial unemployment. And what we observed that they've reduced marketing costs, but they've kept growing, and they've reduced number of people working, but it was still working very well. And so we've observed that a lot of companies were too fast, you know, in a sense, right? And you know, cash was free, and they were hiring a lot. And so post-COVID, we've seen, a reaction from CEOs to be much more cash efficient, and we're seeing that today because we're doing the budget. It's a budget out for 2021. And we think, hey, guys, you can be as efficient with less, marketing expenses, and you can be as efficient with maybe less people in some departments, because you've seen that without those people, you've been able to deliver pretty well as well. So that's also a lesson that we've that all of us, I mean, especially our CEOs, have also learned from that period.
Yeah, I think right-sizing companies and the ingenuity has been quite fascinating. We have an audience question. I'm going to reframe it a little bit, but broadly that do you see climate finance and climate change, sort of green fintech kind of themes being very large in 2021? Nicolas, do you want to start with your thoughts on that?
Sure. In fact, my next meeting is with a company in that space tomorrow morning. So it's been, I would say, it has been a theme already. I don't think that's just a COVID phenomenon. It's just one of those trends that's also, again, being accelerated. We have, at least at Partech as well, have been very sensitive and interested in this general theme of positive impact on the environment and ESG. And in fact, we're now rating our own companies, our own portfolio, and our own investments on that. We had a very successful company called EcoVadis in this space that raised a very large round earlier this year that helps companies and supply chains establish sustainability ratings. And so I think it's, I wouldn't call it the big trend, but it's certainly a solid investment theme that we see many investors look at, and I would expect a growing number of companies being funded in that space for sure.
Matthieu, Joe, do you want to add anything? Joe?
Yeah, no, I think Nicolas encapsulated perfectly. I don't think it's particularly accelerated by COVID, but particularly on our side, our investors are much more focused on ESG than ever before, and that then flows downwards to our focus as well going forward. So we're doing similar exercises rating our portfolio. Quite a few of the investments that we've done are much more, I think there's a lot more consideration of both those things and also sort of diversity in the workplace and those sort of factors.
Sounds good. So I think, we're almost out of time. So if I could leave sort of with, just your views on sort of how you see the key elements of 2021 changing from 2020, like one thing that you think is going to change majorly in 2021 and why you're excited about it. Matthieu, over to you.
Well, I think 2021 will be on the same trend that we're seeing on 2020. Which is an accelerating trend of digitalization. What we're observing is also an acceleration of time between rounds. And, where usually we were used to deploy a fund in 4 years, maybe today we will do it in less than 3 years. And we need to keep more reserves, for next rounds because companies are raising faster and more cash, at each round. So that has changed a little bit, our approach. And so faster rounds, bigger rounds, and accelerated pace of investment will be probably something we have to be careful in 2021.
Joe?
Yeah, I think just sort of building on that maybe is with the additional capital that comes, I think tech will continue to see a lot of investment in this sort of very sort of QE stimulated world. There's a lot of capital that will be chasing for higher risk trades, and VC obviously benefits from that, but that does run the risk that there's overinvestment and you will get companies that are doing more unsustainable competition to acquire customers and all the things that we saw in the last sort of tech sort of bubble. And so I think it's trying to work out that balance and trying to plan and position our portfolio companies for that going forward.
Nicolas?
Yeah, I agree. I would add that the risk, as you say, as Joe said, of re-entering a phase of further acceleration post-COVID and is a risk of exuberance, a feeling of exuberance. And I think we will have to remind our entrepreneurs, and they have to remind themselves to not forget the lessons that they learned during COVID in terms of learning to be more efficient businesses, as Matthieu said, right? Just because COVID is in the past and everybody's vaccinated doesn't mean that we can't continue to optimize our businesses and learn and apply the valuable lessons we've learned during that period as businesses and as humans.
Good point. Yeah, no pent-up demand and going crazy. Well, but thank you all for your time. This has been a great panel. Really enjoyed it. Learned a lot. And, I think we're all looking forward to 2021 and keeping this in mind, fantastic businesses that are being built and hopefully some of the sectors that have suffered hard in the COVID time, like travel and some of the other physical delivery kind of vehicles come back. They already come back in a long way, in a big way, but come back bigger. And we have more entrepreneurs to celebrate in 2021. So thank you for your time. Bye-bye.
Thank you.
Thank you. Thank you.
Bye.
And thank you all. Shwetank there with his panel of Nicolas, Joe and Matthieu. Very good to hear from them all about a COVID-19 world, which is definitely an uncertain one. However, hearing from the panel shows clearly where the opportunities still lie and that the road to recovery may be long, but would eventually be a success.